All right, my markets are open. My people, welcome to this live stream. Just gotta check some quick things before we get started. Technicals. Everything is in order with the stream. All right, everything looks lit. Let's get it started. Let's get this started. So the Bella's officially wrong. That means the UK market's open, the British market's open, and first thing we do is it's Monday. Monday we always see some, not always, but we very often can see some crazy movements in the market. As you see, the US dollar is reacting directly, even on the UK open, and if it does so, that means when the US markets open, we might see some high volatility. I just want to see in what direction the Dixie pulls. And the Dixie, if you don't know, that's the US dollar. That's the US dollar index, based on a basket of several different currencies that it's compared against. One of them be the Japanese yen, the Chinese yuan, the Swiss francs, the Swedish krona, and of course the British sterling. So yeah, the dollar is pumping, which means that we will see pairs that are paired against it probably drop. One of them be gold, and we love to watch gold. Gold be one of my favorite pairs to trade here. So what we got this week is a boot camp. We got a boot camp this week, and this boot camp is basically what is this. I get a lot of questions on trading, and I get a lot of new people that join the Telegram group ask me how to trade. So I'll send out free trading signals in the Telegram group. But just because it's trading signals doesn't mean that it automatically will generate you money. All right? You still have to understand how to trade, and even if it's just the basics, you still have to understand how to take a trade first and foremost. Risk management, very important, because when I call out the trade on the signals channel, I don't know what everybody's account size is, what everybody's budget is. So I can't say how much, what lot size you should use, and so on. And I have to be careful with what I said, because this is not financial advice, nothing like that. So with that said, I decided to do this training. So to learn your people how to take trades correctly, even if it's only signals. We might see, I might extend this bootcamp. This bootcamp is for this week. We're going to go through the basics in trading, how to take trades, what is risk management, proper trading psychology, mindset, very important. 80% of trading is just mindset. I've said that several times. I will keep repeating it. So we'll go through those basic steps: support, resistance, trends, all of that stuff. So if you're completely new to trading, then this is where you want to be. You will learn the complete basics here. And that is to help you with getting started with trading. Now, that after this bootcamp, that doesn't mean that you will be a trader. No, far from it. It takes a long time to become a trader, a profitable trader, and it takes a lot of experience, a lot of hours in front of the charts. So, but this will make you understand trading and how to take trades, especially when it's signals and stuff like that. So let's jump straight to it. But before we go into the bootcamp, we're going to check the markets quickly to see what's going on this Monday. And the first thing we saw was that gold was moving upwards. Not gold, sorry, I mean the US dollar, the Dixie. So it looks like it wants to pull up, and we're looking on the bigger time frame where we are with the US dollar. So after this money printing rally that's been going on ever since 2021 March, I think it was when it all started, we had this whole rally up, and this rally took an abrupt finish in September 2022, and that is when the rate hikes started to kick in, and especially when the rate hikes were started to get more dovish, because what is that the US dollar loves aggressive rate hikes. When the Fed increases the rates, the interest rates, what happens is countries, institutions tend to keep their money in US dollar, because it's more profitable for them to keep their money in US dollar, because the interest rates are higher, so they get a better yield on it, right? So that makes the US dollar go up. But when the rate hikes become hawkish, less aggressive, so in other terms, it becomes dovish, and that what happens then is that uh, institutions, the big monies, look for other options to invest in, and they pull out the money from US dollar, so the US dollar drops. That's something to always understand and consider when you're watching news, or just observing the US dollar, how it behaves, and especially how it correlates to the news that be coming out from the, especially from the FOMC meetings, from the Fed and Jerome Powell when he speaks. All right, with that said, short lesson on the US, on the Dixie, and how it moves against the rate hikes. And then we know also that gold always moves in reverse to the US dollar. So if US dollar goes up, most often you will see gold go down, and the opposite. If the US dollar goes down, most often you will see gold go up. Now, with that said, back to the US dollar first and foremost. With that said, what the US dollar is now is that after this whole bull run that it had, this whole money printing artificial growth, because this is what it is. It's an artificial growth that it had here. It made it has been dropping for the last, what is it, 6 months more, yeah, something like that, 4 or 5 months. Came down. You guys, you see this yellow lines here? It's the 50% and the 61.8% Fibonacci retracement, and that retracement goes from where? It goes from, let me get my highlighter. It goes from this bottom to this top. So it came down to the zone, which is the sweet spot zone. Why do we call it the sweet spot zone? It's because it's a zone where market tends to retrace to. It's a zone where you will find a lot of liquidity on filled orders. So a market tends to do exactly what it has done here, come down to this zone. Sometimes it ranges here, or sometimes it just dips, it toes, and then moves up again, picks up liquidity and shoots up. And that's what we have seen here. So what does that tell us? That tells us that market has picked up liquidity, it might go up. Well, In the same time, what we gotta understand and see is that you see this white line here. That white line represents a major resistance area in this case. So a major resistance zone in this case. So where we are now with US dollar is that we're facing major resistance. As you guys see, it's been resistance, support, reverse to support, came back, support, broke through, and is now retesting it as resistance. So if it doesn't break through this white line, I think we're gonna see a major drop all the way down to this demand zone that is here in this between these red lines, which is the Fibonacci 78.6 and the Fibonacci 88.6% retracement. If we see that, if we see this drop happening, you will see a lot of volatility in the market. You will see Bitcoin pump. You will see gold pump. So a lot of people want that to happen. Very understandable. I'm gonna be honest with you. I want that to happen because, as you guys know, if you've been following me, I'm always rooting for crypto and always rooting for gold. And I believe that gold and crypto will have a severe, not a severe, like a major pump soon, but maybe not yet. Maybe not yet. Like Bitcoin, for example, I can easily expect it to drop down to about 11,400 in this area. That's what I see Bitcoin coming down to. If that happens or not, we'll see. I'm no guru. Nothing I say here is financial advice. It's just my own humble opinions on these markets. Now, with that said, let's take a quick look at Monero. What's going on with Monero? And the first thing I see directly on the 50-minute time frame is the Gartley pattern for GBP AUD, and that's what we see here is a trade pattern in the markets that Monero has spotted for us. For y'all that don't know what Monero is it's basically a software based on AI, powered by AI, that scans the market for patterns and gives you those patterns, shows you those patterns, and gives you possible entry levels, stop losses, targets, target ones, target twos. And for y'all that don't know what stop loss, target one, target two is, this is exactly what we're going to cover today. So in a couple of minutes, let's just finish looking at this market, just so we know what's going on in the markets today, what we see. If we see a trade, then we cash a trade. That's how we always do. So this one looks nice. The only thing is I don't normally trade GBP AUD. So let's jump into Euro USD. That one is already failed. Let's see what we got. So here we got gold on a triangle pattern. It shows us an entry at 1861 with a target at 1872 US dollars. So let's go into back to gold and see and look for confirmations. Let's look for confirmations on this trade. Is this a trade that we are interested in doing? First off, what do you see here? Like, what are all these drawings that you see here? Let me just clean up some of them so it gets more friendlier to the eye. All right. So last week we had the market ranging in this area, in this tunnel, and it's forming a bearish flag. And that's exactly what it was. I thought, like you see these arrows, I thought the market was going to come up to this white line, bounce off there and go down. But it bounced off earlier. It bounced up already. So I thought it was going to bounce off 1894. It bounced off 1890 and made a drop. As predicted, but much lower than predicted. So we missed that trade. The trade never came to our entry. And as I always say, we rather miss a trade than take a trade and lose one. All right? Because a missed trade is no gain, no losses. But a losing trade is a losing trade. That's losses. And we don't want losses. So what is good profitable trading? That's proper risk management, and that's keeping your losses on a low. So taking advantage of your wins and minimizing your losses, of course, makes total sense. But the problem is that even though it makes total sense, that is the most difficult part in trading. So gold came down to the area, and Manara tells us that 1861 is an entry. Oh, is an entry zone for gold. So let's see what if we agree or don't agree on, with that. So I always like to start with the 4-hour time frame. Pull out the Fibonacci. We start with this big swing, with this big drop from here all the way down to this bottom. That doesn't give us much, so what we do is we take Fibonacci from here, from this swing, so from this top to this bottom. Market is ranging, as you guys see, very choppy. These gray zones that you see here is liquidity zones. Now market has cleared most of this liquidity, so what we're looking for now is, this is where a lot of order is. So what we're looking for now is market either, like right now what it's doing is retesting the bottom of this liquidity zones. And these liquidity zones most often also act, these order zones most often also act as support and resistance when you come to the top or to the bottom of them. And what we see now is that market is testing this zone from underneath, right? So if we zoom into the hourly time frame, you see like the market is trying to break in, is picking up orders, trying to break in, but it doesn't look like the buyers can take control of this market. It doesn't look like the buyers got the power. The sellers are winning all the time. So we'll see if the market drops further or not. Right now, it's bouncing off the 20-day EMA, which is this yellow line that you see here. And we'll see if it breaks through and pulls down, or if it moves up. According to Manara, has spotted what pattern was it? A triangle pattern, and is saying that the market will move up. So from 1861, which is perfectly correlated with a 20-day EMA, until, what was it, 70, right? 77, 1877. So that's up here. Yeah, so that's about, yeah, I like this. So that's about in the top of the sweet spot zone. So that's the 61.8 retracement of this drop. And that correlates perfectly because you see this red massive candles that we have here. All of this is liquidity. Now, market has come up and cleared most of this liquidity, but it might come up all the way and clear it again. Now, I'm not very convinced of this trade, to be honest with you. I'm not very convinced that the market will come up here. So this is not a trade that I will take personally. And you guys know that I never call out trades that I don't take personally. I only call out trades that I take personally. So when it comes to gold, we'll see a little bit more what happens here if the market breaks through or holds the 20-day EMA as support and starts pumping up. But right now, it's not an entry for gold. So with that said, let's jump into the boot camp. Let's do this. We're 20 minutes into this live stream, so it's pretty much a good time to do it. All right, so today what we want to talk about is how to trade, how to take a trade, because it sounds very like maybe logical and almost too simple. But the thing is that many people have problems with it, and that's the most I'm getting, like the most questions I'm getting in the Telegram and the Signals group is, how do I take a trade? What is take profit 1, take profit 2, take profit 3? What is stop loss? Oh, I took this trade and now my account is 0. Okay, if that is so, that means you're over leveraging. You are you're having a bad risk management, and you need to look into this. So risk management is what we're having tomorrow. Today we will go through the basic terms so that you understand what trading is. So with that said, let's start with lot size. Lot size is the first thing to understand when you're taking trades, especially when you're taking signals and stuff like that. Now, to understand lot size, you need to understand pips. Pips stands for point in percentage. And to explain it very simple, I used to compare it to steps in the market. So you see this vertical line here. This vertical line on the trading view that I'm pointing at now is representing the price of the market, how much the market moves in price. The horizontal represents how much the market moves in time. So what pips is, it's basically how many steps the market moves in price. So not in time, but in price. How many steps it moves in price. So it's point in percentage. And so sometimes you've been hearing me calling out like, yeah, this is a trade with a 20 pip stop loss. That means the market is moving 20 points in percentage on the price to hit the stop loss, and you must adjust your lot size accordingly so that you don't blow up your account, so that you have a proper risk management. And to understand that, you have to understand what lot size is. Now, lot size is how much you invest into every pip. All right. So pips is how many steps the market moves on the price, right? And lot size is how much you invest to each and every step. Okay. So let's say, or let's put it like this. So you have different lot sizes. You have a micro lot size that is 0.01. Now 0.01 lot size is 10 cent. So that is 10 cent per pip. If you trade with a 0.01 lot size, that means for every pip the market is moving, you win or lose 10 cent, 0.1 US dollar. If you trade 0.1 lot size, then you're trading 1 US dollar per pip. And if you're trading lot size 1, which is a standard lot, then you're trading 10 US dollar per pip. All right? Let me write this down so you get it more clear. I know it can get complicated hearing it like that, but it's always easy when you have it in writing. Wait, let me clear some of this up. But let me do like this. Let's go to another chart where we have less drawings. Let's do like this. Okay. Lot size 0.01 is 10 cent per pip. All right. Now, so lot size 0.01 is 10 cent per pip. Lot size 0.1 is 1 USD per pip. And lot size 1, a standard lot, is 10 10 USD per pip, like that. Okay, so to repeat, pips is how many steps the market is moving, and pips is the steps that the market is moving, and lot size is how much you invest in each and every step. So if you have a brand new account, if you are brand new to this, and you're trading a live account, and let's say you have 100 US dollars on your trading account. If you have 100 US dollars or less, you use minimum lot size, so micro lot size, which is 0.01. You don't use more than that. Everything more than that will be over leveraging. So if you have 100 US dollar or less, then you use 0.01 lot size on your MetaTrader or whatever trading app you're using. That is to keep it very, very simple. So now when you understand what lot size and pips are, then, and if you didn't get it down properly from my explanation now, repeat this, watch the recording, repeat it several times, and also, hey guys, if you're active on the stream now live, write to me in the chat box if you want me to explain something more, go deeper into some explanation or something like that. I'm watching the chat box, so, and I always respond to proper questions and comments. With that said, let's look at what stop loss is. So, when we trade, let's look at the chart. Let's look at the chart. Let me clear some of this up. So when we trade, you see me pull up this tool, right? If you've been on the streams, you've seen me pull up this tool here. So let's say I want to enter a trade here where the market is now. You see me pull out this tool. This green zone is the take profit. That means this is where we want the market to go, and the take profit is, of course, the profit target, where we want the market. We want to see the market to come to, where we're expecting to see the market come to, so we can take our profits, and that is automatically done by a take profit order that you put in. Now, stop loss is the opposite. Let's say the market goes in the wrong direction. We want the market to go up here for a buy, but the market goes in the wrong direction. It starts to go down instead. We need to put a limit to our loss. We don't want the market to just fall freely and blow up our account, right? So we need a stop loss. So the red zone that you see here is the stop loss. Now, how big the stop loss is? Let's say I pull. I'll give you guys this trade, and the trade says that is that we have a stop loss of about 150. Let's say a stop loss of 150. This one is 152 now. 152 pips. Okay, 149 pips. Let's say the stop loss is 149 pips. That's a lot of pips for stop loss. How do you handle it? Well, first and foremost, what you have to do is you have to think about your lot size now. Remember the lot size we spoke about? So if the market moves down all these 145 pips and you have a lot size 0.01, that's 10 cents, how much will you lose? You will lose 14.5 US dollars. If you had a standard lot, if you had a 0.1 lot, which is 1 US dollar per pip, you would lose $145 because it's 145 pips. So if the market goes down 145 pips, we lose $145. If you have a micro lot, which is 0.01, which is 10 pips, 10 cents per pip, you lose 14.5 US dollars. Okay? If you don't get that, please write it in the comments, in the chat box, so that I can reply to it. So, the opposite now. We put a take profit. Let's say this is our take profit here. Our take profit is 922 pips. Now, if the market moves 922 pips, how much will we make on a lot size 0.1, which is $1 per pip? If the market moves 922 pips, how much money do we make on $1 per pip? Well, the answer is simple. It's $922, right? Now, if we have the lot size 0.01, which is 10 cents per pip, how much money do we make on this trade? When the market moves 922 pips, we make 92.2 US dollars. So in this trade here, we would risk with a lot size 0.01, we would risk 14.5 US dollars to win 92.2 US dollars. Okay, I hope that makes sense. I hope you understood that. I hope that kind of clarifies things when it comes to lot sizes and stop loss and pips. So take profit is your take profit level where you want that's the take profit order you put into your MetaTrader to for your broker to execute, which means that if the market goes up and hits your take profit, your broker will automatically execute a sell there so that you can cash in the in this case $92.2 that you would make. And your stop loss is the opposite. It's limit that you have set for your loss, so you don't want to lose more than that. So if the market goes in the wrong direction, then your broker will execute a buy order in this case to a sell order, so that you only lose 14.5 US dollars if you have a lot size 0.01. Now, sometimes in my trades, not sometimes, most often in the signals that you'll be getting in the trading group or in the signals channel, most often you will see me call out multiple take profits. What is multiple take profits? Multiple take profits is, let's say I call out a take profit here, I call out another one here. So take profit 1, take profit 2, and take profit 3. So we say this is TP1. TP1, that's green line. This other green line, TP2. Then the last take profit is TP3. So we have three take profits in one single trade. How does that work? Well, I'm gonna make it more simpler mathematically for me. So I'm gonna call out TP4. I'm gonna pull out TP4 on this one as well to make it easier to explain. Easier for you guys to understand also. So let's say we have 4 TPs, because we very often have it on the trades that I call out in the signals group. So we have 4 TPs. How does that work now? So when you put in a trade on your MetaTrader, and let's say you put a trade that has the lot size, or you want to put a trade. You want to put this trade in, and you want to have lot size 0.1. Now, how are you going to do all these 4 TPs? What you have to do is you have to split that trade up in 4. So that one trade, you divide it in 4. You have split it up in 4. So let me put the text tool again so it gets easier. So we're trading lot size 0.1. We're saying lot size 0.1 is your proper risk management. We have 4 TPs. Okay, what do? We split up that 0.1 lot size in 4. So each TP is now being traded with a lot size 0.025, which doesn't exist. Oh, so 25. which doesn't exist. So in this case, I would say 0.02. Okay. So wait, let's make it more simpler so you guys understand it. Let's say it's lot size 1, standard lot size 1, 4 TPs. We divide them in 4. What does that make? 1 divided in 4 is 0.25. So every trade that you're going into, no, sorry. So this trade, when you're going into it, you split it up in 4 trades. You pop. You press 4 buys, so you have 4 different buys. You put the stop loss in, and every trade is 0.25 if you're using a lot size 1. That's divided in 4. So that means first trade, you put the stop loss in, and you put take profit 1 into the take profit box in your MetaTrader, and you put 0.25 as lot size. Your TP2, you put the TP2 numbers in the TP box, and you have 0.25. TP3, same thing, 0.25. TP4, same thing, 0.25. This is how you split up your one trade into 4 trades, and this is how you make 4 take profits. All of them need to have the same stop loss. They just have different take profits, and all of them have the same stop lot size, which is the lot size you would use according to risk management, but it's divided in 4. It's split up the one trade into 4 trades. Now, let's say you are trading 0, because I have to do this comparison because I know a lot of you guys trade with lot size 0.01. So let's say you use lot size 0.01. How are you going to split this up into 4 trades? You can't. So what I'll always say is, if that is the case, that you're using 0.01, use either take profit 1 or take profit 2. Don't even look at take profit 3 or take profit 4. Use take profit 1 or take profit 2. If you use take profit 2, as soon as the market passes take profit 1, move your break even. Sorry guys, tired. Move your stop loss into break even. What does that mean? That means that when you see the market pass your first take profit, so this first green line, the stop loss that you see, you in your MetaTrader, you put it to the same numbers as your entry zone we're at. In that case, what you do is you have a break-even trade now. So even if the market now reverses, let's say the market bounces off this take profit 1 and reverses back down, you will not lose money because you have put your stop loss into break even. Very, very important. This goes into tomorrow's training, risk management. This is what prevents you from being a losing trader. This is what makes you a profitable trader, from minimizing your losses. So take profit 1, take profit 2. If you use a lot size 0.01, don't even look at TP3 or TP4. But I would recommend take profit 2 is of course a little bit more risky. So it depends on what trade it is. If you don't really know what to do, stick to TP1. If you want to take more risk, take TP2. All right. And with that said, if you are on this level that you don't really understand what trading is, and you just learning to understand what stop loss is and all of this good stuff, then you have to trade with a demo account. Don't use real money. Don't use a live account when you're trading. Trust me on this one. You will not outsmart the market. You're not a genius. You will not. Maybe you are a genius, but you will still not outsmart the market as a new trader. You need to gain experience, even if it's trading signals, and even if the signals you're taking from me or for somebody else has the most perfect track record ever. You have to understand these things, and you learn them the best without losing money on a demo account. So what is a demo account? Demo account is something that you can do when you sign up with your broker, with your trading broker, Forex crypto broker, and you can open a demo account instead of a real live account so that you can demo trade. That means you're trading in the real markets, you're trading you're trading the real markets. You're trading everything what's going on in the markets, but instead of trading with real money, you're trading with fake money. That means you don't lose or win any real money, but it looks like it on your MetaTrader because it's a demo account. So that gives you a good feeling, a good sense of how it is to trade and how it is to take trades and get used to it, get comfortable with it before you start to trade a real life trading account. Now, with that said, what is a broker? Because many of y'all don't even know that. So let me break down what a broker is. So broker is basically the one that when you're trading Forex, when you're trading crypto through a broker, most often what you do is you don't own the money. You don't own the euro, the US dollar if you trade euro USD or whatever it is, or the Bitcoin. Most often what you trade is contracts. Contracts that your broker lets you buy or sell. Your broker actually holds the assets. So you basically bet on if the US dollar versus the euro or the Bitcoin versus the US dollar will go up or will go down. Now, what you can do is you can you sign up with a broker. You deposit the money that you want to trade, that you want to risk, and never deposit more than 10% of your capital. Never deposit more money into your broker than you are not afraid to lose. Okay, very important. Now, we will go deeper into that tomorrow, but never deposit more money into your broker than you are afraid to lose. Because if you deposit everything you have or half of your capital into a broker to trade with, what happens is you will be emotionally attached to that money. All right, you don't want to be that. You don't want to be emotionally attached to the money because then you will trade emotionally, and you don't want to do that. So you want to trade properly, strategically, and to do that, you cannot be emotionally attached to the money that is in your trading account. So a broker, there's a lot of different brokers. So what to look for when you're looking for a broker is regulation, all of that good stuff. Yeah, very good. I always look for, the most important thing is how long have they been active? How long have they been active, and how big is their customer base? How long have they been active? How big is their customer base? And what are people saying about them? Because if they've been active for a long time, if they have a big customer base, then you can expect there being a lot of reviews on this broker. So these three factors are very important. This will give you a very good picture of if this broker is serious or not, if they are liquid or not, if they pay out, if they do the payouts as they're supposed to, or if they don't do it. If people have experienced troubles with this broker, if people have experienced problems with this broker, and so on. So when you sign up with the broker, use leverage. Don't use like you get to pick leverage. Now leverage is how much you can leverage the money that you have in your trading account. It's basically the broker borrowing you money so that you can trade so you can bet more into a trade. Lot sizes, remember lot size is pip, so you can bet more into a trade than you actually have in your account. But now this is a good way to multiply and make money fast, right? But the problem is, if it goes in the wrong direction, you lose fast as well. So you don't want to have a leverage higher than 1.200. Oh, sorry, you don't want to leverage higher than 200. Now you can have a leverage of 1,000 or whatever you want. I don't decide. Like it's your decision. But this is the leverage that I recommend. This here is the leverage that I recommend. One, a 200 leverage, so that you don't blow up your account easy. And yeah, it will just make it more difficult for you to trade with bad risk management, and to over leverage your trades and over leverage your account. All right. So when you sign up with a broker, choose no higher leverage than 200 if you don't know what you're doing, if you're not an experienced trader, and start with a demo account so that you get a hands of how it is to trade. You get a feeling for it. You get used to the take profits, how to put in the take profits, the stop losses, how to split up the lot size into for different take profits, and so on. And so you get a feeling for market movements and all of that volatility and all that good stuff. So this is basically it on how to trade. All right. So what have we covered? We have covered lot size. We have covered pips. What is pips? Is the steps that the market moves. What is lot size? Lot size is how much you want to bet into every step on the price, target here, to how much you want to bet into every step that the market takes. So for every pip that the market moves. And then we have covered stop losses and take profits. So stop losses is your limit for maximum how much you want to lose if the market goes in the wrong direction. So that's it. That is you securing your account for not losing more than a certain level, more than a certain amount. And take profit is your take profit target. So your target of profit taking, where you exit the market with profit. Just to put it very simple. And we have covered what is a broker. So broker is is where you deposit your money to be able to trade the forex or the crypto markets, so whatever the markets are that you want to trade, if it's stocks or so on. And you don't want to use, if you're not an experienced trader, you don't want to use leverage more than 200. You want to start with a demo account, and when you start trading, if you have a live account of less of $100 or less, you don't want to use a lot size more than 0.01, which is 10 cents per pip. So for every pip the market moves, every step the market takes, you don't lose more than 10 cents, okay? Or you don't win more than 10 cents. That is just to be trading safe and not become emotionally attached to the markets, and not to blow up your account too quickly. With that said, that covers the day one of this trading bootcamp, and I hope you got some value out of this. If you did, please give me some comments, like this video, and I will see you guys tomorrow again for risk management. Then we will go through risk management, very important for you to trade profitably and safe. And with that said, I wish you guys a blessed day. Stay prosperous. Salud.